Benjamin Graham is known as the father of value investing and is well renowned for his book, The Intelligent Investor, which we will be reviewing today. In case you didn't already know, this book is regarded as one of the most influential books of investing.
It's really a pleasure for me to be able to talk to you about Ben Graham. I've had some lucky days in my life, but one of the luckiest was in 1949 when I was 19 years old in Lincoln, Nebraska, and I picked up a copy of The Intelligent Investor. It not only changed my investment philosophy, it really changed my whole life. I'd be a different person in a different place if I hadn't have first seen that book.
Here's a short backstory on Ben Graham's life. Graham went to work on Wall Street after graduating from Columbia University in 1914. He was able to build up a substantial personal portfolio during the course of his 15-year career. Graham, like many others, lost most of his money in the stock market crash of 1929 and the Great Depression that followed. These experiences showed Graham the importance of reducing downside risk by investing in firms whose shares were trading at a discount to their liquidation value. In basic terms, his objective was to spend 50 cents on a dollar's worth of assets. To do so, he used market psychology to his advantage, exploiting market concerns. Another one of Graham's books, called Security Analysis, was published in 1934 and was influenced by these concepts. Graham's first goal in security analysis was to assist investors in distinguishing between investing and speculating. Following a comprehensive examination, it should be obvious that an investment would safeguard the principal while also yielding a reasonable return. Anything that does not fulfill these requirements is only conjecture. According to Graham, the stock market operates like a voting machine in the short term and a weighing machine in the long term. Thus, the actual worth of a stock will be reflected in its price in the long run. Now back to The Intelligent Investor. One of Graham's most significant contributions in this book was pointing out the irrationality in group thinking that plagued the stock market at the time. His safe and profitable investment methods continue to inspire investors today, such as the very well-known investor Warren Buffett. One of Graham's favorite allegories was Mr. Market. Every day, this fictitious character known as Mr. Market appears at the stockholder's office, offering to purchase or sell his shares at a different price. Sometimes the suggested pricing makes sense, but other times, given current economic realities, the proposed prices are off the mark. Individual investors have the choice to accept or reject Mr. Market's proposals on any given day, providing them an advantage over others who feel forced to remain involved at all times, regardless of market valuation. It is far better for an investor to focus on the real-world performance of their firms and the dividends they get, rather than relying on Mr. Market's fluctuating feelings to determine the worth of their stocks. If others share their sentiments, an investor is neither right nor wrong, only facts and analysis may prove them incorrect. Now on to value investing. The intrinsic value of a common stock is calculated independently of its market price in value investing. The intrinsic value of a stock may be determined by looking at its assets, earnings, and dividend distributions, and then comparing it to its market price. If the intrinsic value of the stock is greater than the market value, the investor should purchase and hold until mean reversion occurs. The mean reversion hypothesis states that the market and intrinsic prices will converge over time. The stock price will represent its real value at this moment. Benjamin Graham coined the term net-net to describe a value investing strategy in which a company's worth is determined exclusively by its net current assets. When an investor buys a stock at a lower price than its inherent worth, they are effectively getting a bargain. They should sell once the company is trading at its intrinsic value. The next topic is margin of safety. Graham also argued for an investment strategy that gives the investor a margin of safety or allowance for human error. There are a few methods to do this, but the most essential is to acquire inexpensive or out-of-favor companies. Investor irrationality, inability to anticipate the future, and stock market volatility are all reasons why a margin of safety is needed for investors. Diversifying portfolios and acquiring stocks and firms with strong dividend yields and low debt-to-equity ratios can provide investors with a margin of safety. This margin of safety is designed to protect investors from losing money if a firm goes bankrupt. Now on to dividend stocks. Many of Graham's investment concepts are timeless, and they are just as applicable now as when he wrote them. Graham chastised businesses for their unclear and inconsistent financial reporting, which he claimed made it impossible for investors to gain an accurate picture of a company's health. Graham subsequently published a book about financial statement interpretation, including balance sheets, revenue and expense statements, and financial ratios. Graham also argued that businesses should pay dividends to their shareholders rather than retaining all of their income as retained earnings. Someone who follows Graham's principles to this day is legendary investor Warren Buffett. Buffett enrolled at Columbia Business School after reading The Intelligent Investor at the age of 19. He studied under Graham, with whom he formed a lifelong connection. Buffett later worked at Graham's investing business, the Graham-Newman Corporation, until Graham retired. Graham's students eventually created their own techniques and beliefs, but they all agreed on the need of maintaining a safety buffer. Buffett follows the value investing concepts in general, which search for assets with unjustifiably cheap prices compared to their underlying value. Buffett also takes into account a business's performance, debt, profit margins, if the company is public, how reliant on commodities it is, and how inexpensive it is. Buffett's method varies from Graham's in that he emphasizes the significance of a company's quality and preaches the benefits of long-term stock ownership. Buffett isn't looking for a quick buck. He's not concerned with the stock market ever appreciating a company's worth. Rather, his aim is to buy excellent firms that are very capable of creating earnings. Buffett claims that no one has ever lost money using Graham's approach. Although the specifics of Graham's investments aren't publicly available, he is said to have averaged a 20% yearly return throughout his many years managing money. His approach of picking low-risk stocks with high return potential has made him a genuine pioneer in the financial research sector, and his methodology is credited to many other successful value investors. While he is best known for his books in the field of value investing, most remarkably The Intelligent Investor, Graham was influential in drafting components of the Securities Act of 1933. This legislation required businesses to provide financial statements accredited by independent accountants. And that's it for today's video. The Intelligent Investor is an excellent book for anyone who is looking to get into the stock market. If you enjoyed, make sure to like, subscribe, and hit the bell for more videos.